Have you ever wondered why a business can report profit even before the cash actually arrives? That's because many companies use something called accrual accounting. Accrual accounting is an accounting method where income and expenses are recorded when they are earned or incurred, not when the money physically moves. In simple terms, it tracks business activity based on timing of work and obligations, not cash flow. Let's break that down. Imagine a business completes a project in June but doesn't get paid until July. Under accrual accounting, the revenue is still recorded in June because that's when the work was completed and the income was earned. The same idea applies to expenses. If a business receives an electricity bill in December but pays it in January, the expense is recorded in December because that's when the electricity was actually used. So accrual accounting matches revenue and expenses to the period they truly belong to. Now, why is this important? Because it creates a more accurate picture of business performance. If companies only recorded transactions when cash moved, financial reports could become misleading. A business might look weak simply because customers haven't paid yet, or look unusually strong because cash arrived late from earlier sales. Accrual accounting smooths this out and reflects what actually happened during the period. That's why most medium and large businesses use accrual accounting, and why accounting standards like GAAP and IFRS heavily rely on it. Now let's look at the main benefits. First, it improves accuracy by matching income and expenses correctly. Second, it helps managers and investors make better decisions because the financial statements reflect true business activity instead of just cash movement. And third, it improves long-term planning by tracking unpaid invoices, future obligations, and upcoming expenses more clearly. But here's something important. A company can look profitable under accrual accounting while still having cash flow problems if customers haven't paid yet. So profit and cash are not always the same thing. A common misunderstanding is thinking accrual accounting involves fake money. It doesn't. The transactions are real. They're simply recorded when earned rather than when paid. Another misconception is that accrual accounting is only for massive corporations. In reality, many growing businesses eventually adopt it because it provides far better financial insight. So, what's the key takeaway? Accrual accounting records revenue and expenses when they are earned or incurred rather than when cash changes hands. It provides a more accurate picture of business performance and helps businesses make smarter financial decisions. And once you understand accrual accounting, you realize that in finance, timing can completely change the way a business appears on paper.